Do you know one of the biggest factors that impact an investor's return on their investments are the one and only, as you figured, Uncle Sam? In this short video, you will learn the power of the Roth IRA, where many affluent investors use this account to avoid paying taxes to the one and only Uncle Sam. My name is Jack Kirschman of Starlight Wealth Management, where I help families navigate their financial life so they can attain clarity, build wealth, and most importantly, have peace of mind. In the description below, there's a link to a flowchart on some of the rules of the Roth IRA. So if you're feeling a little overwhelmed, I know this could be a bit daunting, just click down there and you'll get a free flowchart sent to you. Let's begin. What is a Roth IRA? Well, a Roth IRA is very simple. You go to a local brokerage firm, you go to a brokerage firm online, and type in you want to open up a Roth IRA. This is a type of account which is utilized for most cases for people retiring, but you can use it however you like. As you'll see, there's all different features. You can contribute up to $6,000 a year if you are below 50, and $7,000 a year if you're above 50 years old. No tax deduction on contribution. That means is when I contribute that $6,000, I don't get any tax benefit at that moment. So then what is a tax benefit? Well, number one, the money grows tax-free. What does that mean? Any dividends, capital gains, interest, all that, if you get that in your account, as long as you don't take it out, tax-free, no problem. And here's a main benefit of the Roth IRA, that at 59 and a half years old, you can withdraw all the money tax-free. The growth, the principal, everything, as long as you follow the appropriate rules. So let's see an example. We have John who contributes $6,000 a year for 25 years. The money is after tax dollars. That means he's not getting any tax benefit for every time he contributes $6,000. The money goes into a brokerage account, and then after 25 years with a 7% annual return, his account values $379,490. All that money can be taken out tax-free. Because it's a Roth IRA, all the growth is tax-free through the years of it growing. And when you want to take it out at the appropriate time, at 59 and a half years old, that will also be tax-free. So what are some limitations? As you all know, every good thing has its limitations. So number one is, as you all been hearing, that you have to be 59 and a half years old to take out the money. There are exceptions, and we're going to get to that just in a moment. The 5-year rule. So this is a very odd rule. This rule states that from the first contribution until 5 years after that, you can't take out the growth of your Roth IRA. And when I say growth, I mean not principal, not the original amount, however you want to call the original amount. The original amount is never taxed, is never penalized. It's only the growth that we're talking about here when it comes to taxes and penalties. So the 5-year rule states that when I contribute the first time, I have to wait 5 years to withdraw the growth of my Roth IRA. Earning a high income is another limitation to the Roth IRA. And as we'll see in future videos, that limitation is not a real limitation, because there are ways to get around earning a high income. If you earn a high income, that can be something called a backdoor Roth conversion. So earning a high income is, if you're filing jointly, it's about over $200,000 a year. If you're filing single, it's about $140,000 a year. It's important to talk to your accountant before contributing to the Roth IRA if you feel like you'll be hitting those levels. Now, just a word of caution here. If the rules aren't followed properly, then number one, there's income tax on the growth. Number two, there's a penalty on the growth too, a 10% tax penalty in addition to whatever income tax you're paying. So it's very important to follow the rules when it comes to the Roth IRA. So what are some exceptions to limitations? So number one, as you all know, you're 59 and a half years old, and you follow the 5-year rule. Even if you're 59 and a half years old, you must follow the 5-year rule. You become disabled. So if at 40 years old, before you reach 59 and a half, obviously, you become disabled, you can take out the growth, You can take out the principal, obviously, or the original amount, whatever you want to call it, tax-free, penalty-free. Another not such a well-known feature is the $10,000 first-time home feature. And that is, if you are buying your first-time home, you can tap into your Roth IRA, the growth of the Roth IRA, up until $10,000. Now, the principal or original amount, however you want to call it, can always be taken out tax-free, penalty-free. When we talk about the exceptions here and the rules of penalty and taxes, we are always referring to the growth of the Roth IRA. So if you want to tap into your Roth IRA's growth, you have up until $10,000 for your first-time home, which is quite awesome. So why is a Roth IRA so powerful? So number one, if after all your years of working, you're 65 years old or 59 and a half or whatever age it is, you accumulate $3 million in your Roth IRA. You're going to ask me 1 second, how do you get $3 million in your Roth IRA? Well, we're going to talk about it in future videos, but there are strategies out there how you can really take advantage of the tax-free growth and the tax-free, you don't have to pay taxes on when you withdraw the money by all sorts of strategies, mega back to Roth conversions. There is, back to Roth conversions. There's rolling over from other accounts. We'll talk all about that later on in future videos. However, let's say you have $3 million in your Roth IRA, and now comes retirement, and you're concerned, I have $3 million, but I got to pay taxes. The answer is no. You don't have to pay a dime in taxes on any of that $3 million if you follow the rules properly. So basically, you can live in retirement off this $3 million and not pay a dime in taxes. So number two, as I keep mentioning over the course of the video, the principal, the original amount you contribute, is never taxed and never penalized. So let's say I'm young, I know I need to buy a house soon, or I know I need to send my kids to college, and I'm concerned about putting away money that if I take it out, I could be penalized. So what do I do? Well, you could put it in a Roth IRA because the original amount that you contribute can always be taken out tax-free and penalty-free. So if I contribute over the 10 years, $6,000 a year, which is $60,000 after 10 years, I can pull out that $60,000 with no problem whatsoever. So this is a great account to take advantage of saving for retirement, for whatever goal you have in the future, knowing that you could always take it out. Now here's a quick reminder of the flow chart I have for you. In the description below, there's a link to a flow chart that you'll receive on the rules surrounding the Roth IRA. So if you want to just brush things up, get things a little more clear, have a clear picture in front of you about some of the rules of the Roth IRA, hit the link below and you'll receive a flow chart. Now, if you enjoyed this video, please give it a thumbs up. And of course, always remember to subscribe for the latest videos on how to get more clear with your personal finances. Thank you. I'll see you next time.